One of the main goals we strive for here at the Educated Homebuyer is to make sure you guys are fully informed of new programs that are coming out that could affect your affordability, that may allow you to get more bang for your buck, if you will. And I realize we have a nationwide audience that listens to this podcast, but we have a program here in the state of California that is going to help a lot of people be able to get into properties that wouldn't otherwise be able to purchase a home. So we wanted to spend a little bit of time and talk about that. And Josh, you and I discussed there are programs like this across the nation in different states. You know, there's similar types of programs. So, you know, even if you're not in California, you might want to still listen to the information that we're providing today, because it's, you know, gives you really good information on how these programs work and how they can actually benefit you in the long run. So Josh, today we're going to be talking about the California Dream for All Shared Appreciation Loan. So first, I want to start with, what is it?
Super simple. It is it's a recorded second trust deed against your property. So it is a loan. It's a lien against title, but there's no payments. There's no interest. When you repay this loan, and we'll talk about what triggers when you have to repay, but when you go back and repay it, you will give 20% of the appreciation on the property in addition to your initial principal. So if you had a $500,000 purchase, they're going to give you your 20% down. They're going to give you the use of your 20% down while you own that property with no payments, no interest. But when you sell it, if that $500,000 property has gone up to $600,000, you're going to give them 20% of that $100,000 of appreciation. So in this example, you give them back the $100,000 that they let you use for the period of ownership, and you give them 20% of the appreciation, or $20,000, that you would repay $120,000.
Now, Josh, I'm going to go off script really early here and say, you know, there's a lot of people out there, right? Because I've talked about this in videos, that are saying, who would do this? Why would I, buy a home? And even though it's a gift, you know, to get me into the property, why would I do this and have to give them, you know, appreciation back to them? Why wouldn't I just buy with less money down and be able to buy the home, and therefore I don't have to stick to their guidelines or do what they're asking me to do?
Well, Jeb, I like that you went off script. We're going to go and just go right to the very end. Not that we're not going to come back and go through the details in the middle, but no one has really run through the numbers of saying, what does this money cost me? Because when you hear that and you say, hey, if in 10 years your home's gone up $100,000, you got to give these people 20% of it, you go, oh, that's awful. But if we look at it and say, what does that money actually cost me? The figures I'm going to give you right now, Jeb, come from two examples that the California Housing and Finance Agency put out themselves, one for a standard income borrower and one for a low income borrower, because they pay back a little bit less. You only essentially give up 15% of the appreciation going forward. But the example they use is, you buy a home for $500,000. They give you $100,000 down. You resell it for $700,000. We just went through those numbers. We went through a situation where it only goes up $100,000. In their example, goes up $200,000. So you're paying back 20% of that, or $40,000. You're like, that is a lot of money. So what is that money actually costing you? Well, we have to look at how long did it take for that house to go up from $500,000 to $700,000, because that's going to dictate what the money really cost. If it happens in 5 years, you were realizing 6.75% appreciation per year, and that money essentially cost you about 8%. So would you borrow from someone your total down payment, so you don't have to come in with anything, and pay 8% in the current environment for a second mortgage to 100%? That's a pretty darn good deal. And that's with rapid appreciation. Well, let's say it takes 10 years. Well, now the appreciation is only 3.37% a year to get that same appreciation, and you're essentially paying 4% interest. In the current environment, would you take a 20% down payment from someone and pay them back 4% at the end of that timeline? And again, if it takes longer, it goes out 15 years, you're only paying 2.25% on that money. So the longer you have that money, the longer you keep it, and the more appreciation you realize, the better off you are. Like, the only situation where it would give you any pause is if in the next 5 years that home doubled in value. You and I have already talked ad nauseum on this show that we don't think there is any recipe for that type of appreciation. So anyone who has the ability to qualify for this loan, to my mind, it's a no-brainer. You would absolutely positively do this because it's the cheapest money you will ever get to enable you to get into a property at a very reasonable monthly payment.
Important to note here, if you're a home buyer and you're in California, even if you have a down payment, there's a chance that you can still qualify for this program and still get the 20% that we're talking about here in this example. So Josh, let's kind of back up where we probably originally were headed and talk about who actually qualifies for this type of financing, who qualifies for this type of program.
So in broad terms, and then we're going to go into some of these definitions, first-time home buyers buying in the state of California to occupy their primary residence. And it has to be a single unit. It can be a single family. It can be a condo. It can be a PUD. It can be a manufactured home. If it qualifies for Fannie Mae financing and you're going to own or occupy and you are a first-time buyer, you will essentially qualify. So the first one is super easy. Properties in California. Pretty easy for us to determine. Is it one unit? Is it a single unit? Also pretty easy to determine. Must be owner occupied, even to the point, a lot of our first time buyers, they will have a parent or another family member co-sign with them that is not going to live with them. You cannot have any non-occupying co-borrowers on this loan. Everyone has to be a first time buyer. Everyone has to live in the property. So a little bit of additional restrictions above and beyond what other programs have. Now, a question, Jeb, that we always get: what is the definition of a first-time buyer? So there's many of them. The only one that matters in this instance is, what does Cal HFA consider a first-time buyer? A borrower who has not had an ownership interest in any principal residence or resided in a home owned by a spouse during the past 3 years. So an interesting thing there, Jeb, pay attention, had an ownership interest in any principal residence. If you have a rental property, my understanding, they're going to get your tax return. They're going to see that you have not lived in that property and you have rented it out, and you can be eligible for this program. I have never done one, but that's how the guideline was explained to us yesterday. You can't have owned a primary residence within the last 3 years, and they're going to have us provide your tax returns. They're going to look at that, see where you've resided, if you owned it, if you declared any interest deduction.
To note here, Josh, is that a lot of people, when they think of Cal HAFA, they think FHA. At least here in the state of California, this is a conventional loan. So you're buying a property, they're giving you 20% down. You're doing a conventional first mortgage, no mortgage insurance, no upfront mortgage insurance like an FHA loan. So a way better loan, all in many terms. But let's talk about, Josh, a little bit deeper on the details. What kind of FICOs we need, what kind of credit scores rather that we need, what type of income, is there a max income, is there a minimum income? I think that's a good place to go from here.
Let's start with the income. That's the next most important restriction. There's no minimum other than you have to have enough income to qualify for the program. So if you find a home for $200,000 in the state of California and you're only getting a $160,000 loan, be fairly low income required to qualify for that. But let's look. The Cal HFA, they put out a chart, shows you county by county. We can't go through all of those here, but I want to give you broad strokes. The minimum is $159,000. So the lowest threshold is $159,000. So if your household makes less than $159,000 anywhere in the state of California, you will be eligible for this. Now let's look, what's the high end? We can guess. Silicon Valley, Bay Area, right? So we got Marin County, San Francisco, San Mateo, Santa Clara. You can go all the way up to $300,000 income. And strangely enough, in those areas, that may not be enough for you to qualify for a lot of homes. Orange County is at $235,000, pretty darn solid number. San Diego, $211,000. Los Angeles, $180,000. For us in Southern California, a lot of first-time buyers gravitate to the Inland Empire, $173,000. So fairly solid income limits, allowing you to make a good amount of money and qualify for this program. So secondarily, you said some important things. Debt to income ratio, FICO score. So your debt to income ratio is going to be determined by your FICO. To be eligible with standard income qualifications, you have to do 680 FICO, and you're going to be limited to a 45% debt to income ratio. If you're 700 credit score or above, you can go all the way to a 50% debt to income ratio, which one of the things with the Cal HFA loans that we always talk about, they limit the DTI. If you have a 700 credit score, which, Jeb, we did that episode a few months back, the median score in the US is 720, 725. So if you're within the range of median or above, you're going to be able to go to a 50% debt to income ratio. You already hinted at some of the big benefits, Jeb. There is no payment on that 20% down. So even though there's a lien there, it is as if you had a 20% down payment. You're getting a much smaller loan than an FHA 96.5%. Second piece of it, doesn't have mortgage insurance if you structure it that way. So again, the savings is significant. We have a joint client right now that we had on another program. We just looked at it for him. The difference in monthly payment is $700.
Actually, I was going to go that direction. A client buying a home here in Southern California, purchase price is $660,000. They were doing an FHA loan, putting 3.5% of their own funds down. Which in this case was just over $21,000. I don't know what their payments were, but Josh, you went to this seminar, heard more details about this program, came back and said, Jeb, I think we can switch them to the Dream for All program. They're going to get a 20% down payment up front. It's essentially going to save them $700-800 a month. That's huge.
Yeah. Yeah. And we'll go through. I mean, it's not free money. There is a lien sitting there that is going to get repaid at some point. We kind of went through what that repayment looks like, but it is really low cost money. Most people, when you say, hey, I have this option that there will be some repayment at some point in the future at a fairly low rate of interest, but it's going to save you $500, $600, $700 a month.
Well, let's talk about that. So if you're saving $700 per month, I mean, that's $8,400 per year. If you keep that property for 5 years, that's $40,000 you've saved just in the monthly payment alone. So even if you had to pay back $40,000, you're essentially in the exact same spot you would have been doing the other program, which again, I don't think is going to be the case for a lot of people out there paying $40,000, which we'll talk about in some examples. But, let's go a little bit deeper on LTV, putting some additional money down. How much can you put down? Can you get additional funds on top of the down payment from the Dream for All program?
So let's start with the additional money down. I had a client here, had reached out. They said, hey, we're interested in this program, but we've got a number of questions. One of them being, how much am I allowed to put down? They qualify for about $700,000. They're in a fortunate situation. They have a 50% down payment. They only qualify for the $350,000 mortgage. They say, can I do this and get a 20% down? Because if so, we could add about $200,000. We go to $900,000. They put that 20% in there. Is that possible? And what we found out is it is possible. There's a minimum combined loan to value for this of 70%. So meaning they're giving you 20%. So that takes that combined 70% down to 50%. You can't put more than 50% down on this. So if like them, you're in a situation where you have a large cash position, you have an inheritance, you could be low income and be like, I don't know how we're ever going to buy. But again, Uncle Stan dies and you have $150,000 for a down payment, you get $150,000 from the state, and it gives you a much more reasonable payment that buying may be an option for you that it wasn't. Stan. Now, Jeb, let's rest in peace, Stan. Let's transition to the things I think is probably more likely. We talked about this, not having mortgage insurance, that it's 100% financing. Well, you can actually go to 105% on this. You can get down payment assistance from outside sources. Cal HFA has programs where they will do second and third mortgages to help you cover your closing costs. That cannot be used in conjunction with the Dream for All. But if there's another community organization that will give you a grant or a second lien for your closing costs, you can go up to 105%. But what I think is going to be the most common outcome here with the Dream for All program is a borrower is going to say, I will put 15% down. I will go to that 105. So I'm getting an 85% first. I'm getting a 20% second for 105%. And I use that 5% to cover all of my closing costs. So in that instance, a borrower can walk into this deal with no money out of pocket. And the only thing they're trading, obviously you're going to have slightly larger loan because you have 85% first versus an 80. And you're going to have mortgage insurance. For a borrower, a good borrower, 720 plus credit score, 2 borrowers, you're looking at a 0.24, 0.25% mortgage insurance rate. If you have much higher credit scores, it could be even lower than that. So for most people, would I like to pay a 0.25% in mortgage insurance and not come in with any money? or do I want to use my money? There's no right or wrong answer. If you have it, you may choose to do it. But if you don't have it, you're like, I don't have those funds. I'm happy to
And going off topic once again, what do you say to the people who are going to say this is leading us down a path where people, have no equity in the property, they have nothing in the property, and if something happens, they're just going to walk away, and that's going to put them back in a position, or put us in a position, like we were in 08. Let's not even say 08. Let's just say there's no equity in the property. Something goes sideways. I've got no skin in the game. I'm going to walk away. Is that more likely in these cases?
Absolutely some validity to that. The big difference to say 2008, those loans were crazy. You would have a 5.5% first on a 228, and we hit, you take that out in 2006 and 2008, it adjusts and it's going up to 7.5%, 8.5%, 9.5%, depending on the terms of the loan. And you had a second at 12% that you were paying interest on. There's no payment, and you have a reasonable fixed first. So definitely validity to the concerns of what you're saying, much lower than what we saw 15 years ago, but truly valid concerns. Jeb, another concern that you had mentioned saying, hey, first-time buyers are still having a hard time in California. The media would love to tell you that the market is dipping and, sellers are cutting their prices and you go in and name your price. You and I deal with buyers all day, every day. That's a pretty rare occurrence that someone just gets to write an offer and get it accepted. There's negotiations, there's back and forth, there's multiple offers. And when we have that situation, and now we're arming more buyers with the ability to pay more for homes, there's a risk. So, Jeb, for me, where that leads me is, how much of a risk? How many of these are we doing? Right now, the state of California has allocated $300 million for this program. That sounds like a lot of money, right? But before we came on here, you and I ran the numbers at $750,000, with that being the state median, $750,000. Most first-time buyers, most Cal HFA borrowers are probably going to be lower than that. So we took a figure of 80% of that, $600,000. That means this 20% second would be $120,000. Approximately, the state has about 2,500 units of these loans that they can do. We ran the numbers, Jeb. Currently, we're selling about 24,000 homes in a month in California. If 10% of borrowers use this, the money's gone in a month. So I think we're going to be out of money within 60 to 90 days. And for the year, what are we talking? 1% of homes in the state will have used the program. So systemic risk, very, very little. We will only know how this performs over the long
good stuff. Yeah. I mean, annualized, we're selling about 235,000 homes a year. So, 2,500 of them, if everybody defaulted, unlikely to start, but very, very small percentage to start. But the important part, I have this loan, the 20% down. I've bought a house. I want to do something, maybe sell, refinance. When do I have to pay the money back?
So any transfer of title it's written in the guidelines, and their underwriting manual on this is not long and it's not explicit. So if I put it into my trust, does it trigger me having to pay it off? If I get married and I want to add my new spouse on it, does that trigger it? Doubtful. But if I own the house with this and I transfer it to Jeb, probably going to trigger that being repaid. Selling the property, paying off the first lien. And this is an interesting one. Most people go, it's a $400,000 loan. I'm not paying that thing off anytime soon. Well, think about this. At the end of 30 years, you will have paid off that loan, and it is due and payable. So this you can't have it sit out there for perpetuity. Like, you could say, I'm going to get in. This is an awesome payment. I'm happy to own a home in California. I'm never moving. Cool. Once that first mortgage is paid off, you also have to repay the state. So that's an important trigger to consider. It's 30 years down the line, not a big concern for most people, but it is a concern there that you would have. If you pay off the subordinate loan principal balance, well, no kidding. If I pay it off, I have to pay it off. That one's a pretty simple one. Now, this is the big one to all buyers that they want to pay attention to: refinance of the first loan. So they have one asterisk in there, and I'm going to read you exactly what it reads, because this is exactly all and everything that we know about your ability to refinance your first mortgage if you take out this loan. It says, during the life of the shared appreciation loan, Cal HFA will allow borrowers to refinance the first mortgage loan into a single limited cash out refinance as defined in the Fannie Mae Selling Guide without requiring immediate repayment of the shared appreciation loan one time and one time only, so long as you also comply with Cal HFA's resubordination policy. And what I can tell you is that subordination policy has changed over time, sometimes more restrictive, sometimes less restrictive. The simple reading of this is you will have one opportunity in the time that you have that loan to refinance to a lower interest rate with no ability to take cash out. So
rates drop a quarter. Don't go out there and try to refinance it immediately. You might want to pause just for a bit.
Well, think about that, Jeb. What do we usually say? We did the refinance episode last week. If you have a $500,000 first loan, if you have the $500,000 first loan and you take the 125,000 rule of thumb, divide it by 500, that says I need to save 0.25%. If I have this, there's no world in which I'm going to refinance for 0.25%. I'm waiting for an opportunity to save 0.5% or a full percent. So it requires some foresight of you knowing or thinking you have an idea of what's going to happen with interest rates in the future, but absolutely do not get trigger happy and refinance the first time you have the ability to lower.
Now, there's one on here that I think is super interesting, and that's the idea that if the property stops being your primary residence, we often have people saying, hey, listen, house hacking, I'm going to buy a house and then I'm going to live in it a couple of months and I'm going to turn it into a rental. Well, in the case that you do this with the shared appreciation loan, that can essentially trigger the repayment of that 20%. Is that right?
That's my understanding. Again, the way it was told to us, that if it is no longer your primary residence, it will trigger that, much kind of like a reverse mortgage does. Not necessarily the easiest thing for Cal HFA to determine, to find out whether it's still your primary residence, but there are ways that they could potentially become aware of it. The other one that we don't even want to really talk about, the filing and recording of a notice of default. So if you go into default on the first mortgage, it will trigger default on the second. And unless that notice of default is rescinded, they're going to call the second due. They're basically going to protect their rights in that property, just like any other second.
Good stuff. And more importantly, Josh, probably the one thing people have been waiting to hear is what type of rates, what are the rates for these types of programs?
So they are posted every day by Cal HFA. They don't change often, weekly, monthly, sometimes. Right now, if you do not meet the low income requirement, so if you're not at 80% of your area median income or lower, you're at 6.375%. If you qualify for this program and you do meet their low income requirement of 80% of the area median income in the home that you're buying, it drops down to 6%. So the vast majority of people are going to be at 6.375. Some folks will be at 6%. And
so with that said, at the time we're filming this video, where are conventional rates today? If you just a
It's right in line. The funny thing is I ran that number for the gentleman who was asking, hey, if I put money down, where does this look? We ran the numbers of his 700,000 purchase with 50% down, and we ran this. He could get maybe an eighth, possibly 0.25% lower, but certainly not enough lower to offset or mitigate the benefit of this large amount of money that you're not making.
So super competitive, and interest rate doesn't really matter so much on the interest rate. It more matters on the DTI. Is that correct?
Not following.
I'm sorry, not interest rate. Credit score. Credit score matters more on the DTI, not on the interest rate. My bad. Yeah,
100% correct. They don't look at it. So if you meet the criteria for their program, you get 6.375, or your low income, you get 6%. It's binary.
I was over here wondering why you couldn't figure out my thought process, and then I realized what I said. So people out there are listening to the numbers, going, okay, let's get an example, Josh. So I think it's important here to talk about some examples. What we can do here for those of you listening is we can provide a link where you can actually download these examples so you can check them out for yourself and you're not having to memorize the numbers that we're discussing. But let's start by talking about a $500,000 purchase to give people what they would expect to repay in this example. And let's talk about not the low income, but the regular moderate income buyer in this case. So they make 80% of the area median income or higher. So here in Orange County, where we're located, I think we looked, it was like $96,000 where we're located here. 80% of that is in the $70-something thousand range. So if you make more than that in this case, what do the numbers look like?
Absolutely. So again, using that same example, this was provided directly from Cal HFA. So $500,000, 20%, they're going to give you $100,000. So you're getting $100,000. And their example uses appreciation going up to $700,000. So we went from 500 to 700 over an indeterminate time frame. It's $200,000 of appreciation. You are going to pay them back the $100,000 that they gave you plus 20% of the $200,000 of appreciation. So $40,000. So if you get somewhere down the line, you sell that house for $700,000, the payoff demand from the state, from California Housing Finance Agency, is going to be for $140,000 in that instance. So in terms of saying, how much did that cost me annualized? What was my interest rate that I was paying on that? Goes back to the start of the show. Did it appreciate $200,000 in 3 years or 33 years? Because that's what's going to dictate how much you paid.
Got it. And so the second example we're going to use is somebody in the lower income, right? So you make less than that 80% median income. And, are we doing the same example? We're going a little bit lower and saying $400,000 purchase in this case. What does that look like?
Yep. So they are giving you 20% of the 400,000. So they give you 80,000 to assist with your down payment. And in this example, it's the same thing. Goes up $200,000. So you sell it at some point at $600,000. We got $200,000 of appreciation. In the previous example, there's two ways you can look at this. You're still looking at the 20%. So it's $40,000, but you only pay 0.75% of that, 75% of it. So in this instance, instead of paying back $40,000, you would pay back $30,000. The easy way to look at it is how much ever the home appreciates, the difference between your sale price and your purchase price. If you meet that low income criteria at time of purchase, you will pay back 15%. So in this instance, $30,000 on the $200,000, you borrowed $80,000 on the front end, you would pay back $110,000 when you resell.
No, so good stuff. So if you're listening to this video, wondering, if you qualify, how you get in touch with somebody, understand that not all lenders out there have the ability to do Cal HAFA loans. You have to be approved with a Cal HAFA lender. So if you want to get in touch with somebody that can guide you through that process, answer the questions that you have, see if you qualify, there's a link in the description below. Go there. We're happy to connect you with Josh, somebody that can, that can guide you through that process, answer your questions, and ultimately, hopefully, get you to the finish line with it. But with that said, Josh, any final thoughts on the program that you want to mention today?
They're going to run out of money quick. So if you're interested in this, two pieces. You need to get pre-approved real quick, and you need to get out and get very serious about making offers on a property. We'll know, as of today, the program has been live for 3 days. Today is the third day. So we have no idea how many of these applications are coming in, how quickly they are closing. But our best guess, everyone is saying there's 2,000 to 3,000 of these that can be done. I would say we'll be out of funds within 90 days. With the state budget issues, who knows whether this will be reallocated in terms of the next budget. I think the fiscal year runs through June. So we could have more money again in the second half of the year, but no guarantees of that. So if you're interested and you think it works for you.
Yeah, and something important to note, not pushing you to buy a house, right? Just mentioning that there probably is some sort of time restriction on it just because there's only a limited amount of money. So if it's right for you, great. If it's not, and just not the right time to buy, and it's something that hopefully when you're ready to buy, you want to consider, just keep doing what you're doing. Don't get caught up in the hoopla of it. Just stay informed, stay educated. But with that said, we appreciate you listening. We appreciate the continued support. We'll see you next time. Adios.